Hi, I'm John. This morning we're going to talk about cash flow transparency. So important to begin with, what we're going to cover today. So firstly, the key cash flow components. After that, we're going to chat through cash flow trends, what to look for, and then of course, third but not least, key disciplines when it comes to cash flow. Obviously, cash is a critical component in any business. And you often wonder, where's my cash gone? Where's it disappeared to? And I need to look and see and understand. So that's why we talk about the three main components. So namely, operating cash flow, free cash flow, and net cash flow. And it goes in that order. So these components influence obviously the profit and loss and the balance sheet. So operating cash flow starts, that's your revenue, your income, all the money that you generate. Doesn't matter what business you're in, whatever revenue you receive, and then of course subtracted from that are your cost of sales or cost of goods. Those are your direct expenses that you obviously need to incur to actually deliver that service or whatever you produce. Less your expenses, adding other income, and then less cash tax paid. That all comes through the profit and loss, so you would be familiar with that, you would see that. But then there's a few other components that go through the balance sheet. So, change in accounts payable. So in other words, as you've received cash in, your accounts payable goes down. Or the other way around. Again, change in current liabilities in terms of what you owe. Change in accounts receivable, changes in your stock levels if you carry stock, changes in work in progress, and change in other current assets. So all of those components make up what does your operating cash flow dollar number look like. Then if we move forward, the next one is obviously free cash flow. So again, free cash flow, nothing around the profit and loss. This is all in the balance sheet. So change in fixed assets. So you might have purchased fixed assets or sold some. Change in intangible assets, those assets that have value but might not be physical. And then obviously changes in investments and other non-current assets. So that equals your free cash flow. So essentially, after you subtract your capital expenditure, because you obviously need to purchase capital items, then that will give you that result. Right, then finally, we're talking about net cash flow. So again, this is all linked back to the balance sheet. So your net interest after tax, which comes out if you've borrowed money, whether that's from shareholders' loans or from banks or other lenders, interest comes off there. Change in current liabilities, that might go up, you might lend more money. Then obviously dividends, so dividends go to the shareholders. That also comes out of your free cash flow before net cash flow. Then change in retained earnings, which is your bottom line number in your balance sheet, and then any adjustments that you might make. So that's your net cash flow. So lots of components go into it. And in summary, the first one is obviously your operating expenses or operating cash flow impact, then your investing cash flow impact, and then obviously financing activities that come after that as well. Let's talk about cash flow trends. There's a couple of key things around cash flow. It's not just about understanding the money that comes into the bank account and goes out. Back to again, what does it look like? Where's my cash going and where is it in my business? So first trend, looking at your accounts receivable. So this is around where you have accounts. You have those that are debtors that pay you. So you give them terms, whether it's 30 days from statement, 30 days end of month, whatever that looks like. You will have account receivable. Then accounts payable. So this is where you have to pay your creditors. So they will issue invoices to you for, or bills to you for stuff that you've purchased for your business that you need as input. And then of course, if you have stock, most businesses do, some don't. Even a restaurant might have stock, like your stock is obviously your fresh produce that you have, that you keep. So looking at that average time to turn that stock over and see. So when you're looking at that, that's all about cash conversion. So it's what you actually receive from your debtors, what you actually pay to your creditors and suppliers, and then of course the stock. So it's one thing to purchase it, but if you're not moving that stock through, then that becomes an issue. So I'll give you an example. One of our clients their stock levels were just climbing and climbing, and obviously then their payables were climbing as well because they have to pay for that stock, and those stock levels weren't reducing. So that's an issue around control. So when you actually graph these and you put them against each other and you look at them over time, that really gives you some really interesting trends to look at and consider. And what you're looking for there is obviously changes and what the movement looks like. Second one is around your cash position. So obviously that's cash on hand, what's in the bank account, also really important. And then of course accounts receivable, what's owed to you. That's really your cash position. Then thirdly, your profit versus cash flow. So earnings after tax, when you look at that, you would think that's your bottom line, but it isn't. And then again, going back to free cash flow, that's after you've paid everything else, including your interest and anything else out of the balance sheet piece. That normally catches people off guard when there are those expenses that or costs that are in the balance sheet that are going to come out. Great example is, oh, we've got to pay superannuation this quarter or this month. Oh, I've got to pay BAS, right? Where does that sit? Well, that sits as liability in your balance sheet, and then obviously that knocks your cash flow. So again, those are just 3 examples of trends to measure on a monthly basis, looking at what you can see. All right, key disciplines when it comes to cash flow. I think I mentioned in the beginning, cash flow is really critically important to a business. It is the lifeblood. If you don't have cash, but you have clients, that's not going to help you. So you need to know your cash flow trends, which we just spoke about before. You always need to do cash flow forecasting. And there's some great tools these days to help you with that. You need to know what your cash position looks like moving forward. It's less about the day-to-day management. It's about future trends. Are you going to have enough cash? Are you going to run short? What does that look like? You need to make sure that you're doing forecasting. Big changes in the business will impact cash flow. You've employed a new staff member. That's going to reduce cash flow. You've suddenly got a massive order from a client. That's going to reduce your cash flow because you've got to purchase more goods to actually deliver that job. You might need to spend more time on that. There's more labor costs, whatever that looks like. So big changes in your business, that'll impact your cash flow, and you need to understand that and know where you might potentially need to make plans to get cash in. Cash flow is obviously integrated into the profit and loss and the balance sheet. Really important. People forget about that. So again, balance sheet cash flow items can catch you out. The BAS, your superannuation, and PAYG, depending on whether you're on monthly for that or quarterly. And again, the other piece that you have too. So it's a great thing to make a profit, but if you've made a profit, you have to pay tax on that. And then the ATO says to you, right, I need you to pay that tax bill in advance for the next year, assuming you're going to make a similar profit level. And so then that's an extra cash flow item that comes out, which would be in the balance sheet. So again, more than just cash through the bank account. Cash flow forecasting. So what you can see here is just a summary. It gives you a bit of a table around cash in and cash out. There's another view where it gets down to the nitty-gritties at a general ledger individual account name and number. So really important to have a look at that. Really important to remember a couple of things. Number one, your month-end cash balance doesn't relate back to your day-to-day balance. That could differ. So you might actually dip into the red before you actually get to month-end when all your debtors pay you. So again, you need to look at in between. And so then if you look at the graph on the right-hand side of the slide, there you'll see, okay, it's in the black, or then it dips into the red. And so there's some really good tools that we can help you with there in terms of forecasting and really understanding what that looks like. Then what's important is, right, so we've spoken about the concept around operating cash flow. We spoke about free cash flow. We obviously spoke about net cash flow. So what are the levers? What are the things that I can use to influence that? And so, for example, we had one client that came to us, and you'll see on the slide there, they were negative $15,000 on operating cash flow, and they wanted to get to 10,000 positive. So a couple of variables. So you can see obviously pricing. So when last did you increase your prices? That's one way to get extra cash in. Volume, obviously, so the amount of work that you can actually push through or do and execute. Then your variable cost of sales. So your variable cost of sales are obviously linked directly to what your revenue looks like, those direct costs. So in other words, if you do a job for $100 and you need input cost of materials for $50, that's obviously your variable cost. If you didn't have the $100 of revenue, you wouldn't have had that $50 variable cost, right? Or your cost of goods sold. Then again, fixed expenses, you can change that. Then again, so here, really important, so receivable days. So getting your money in quicker, right? That'll create cash. Then payables, maybe perhaps extending that out or changing those terms, looking at that. And then obviously, again, your stock, your inventory days, how long does it take you to actually turn your stock? So again, lots of levers. This is a great tool where you can play around with. Yeah, I think pricing, I can do 10%, I can change my prices. Okay, that's going to give me some money towards my goal. And so you go. And these are some of the things that we can help you with. Right, what are the metrics influencing free cash flow? So similarly, in this case, you've got not much of a change. So you can see in the center, like sensitivity, right, what do I need to adjust to get it from 13 to 14? It's not big. But again, what are the prime drivers there? So variable cost of sales, so really important. That's one that you can do. And then fixed assets, maybe. Again, your pricing, again, your volume, and fixed expenses. There are a couple other things too. Again, on the next slide, you can see again, also receivable days, payable, and inventory all have an impact on where your cash lands. Finally, on that net cash flow, so again, you can see there's similarities. They all have an influence along the journey. So again, variable cost of sales, fixed assets. But again, here's a different one, right? Effective interest rate. Because remember, that's where your interest is paid in that component between your free cash flow and net cash flow, whatever your effective interest rate is there. So again, when last did you look at your interest rate? When last did you negotiate what that looks like? Really important. Again, price, volume, fixed expenses, interest rate on cash, and then dividend payout rate. Because remember, dividends is in that last one. So what are you going to pay to the shareholders? What's your policy around that? What does that look like? Do you rather pay debt back before you draw dividends? So again, you can see there's multiple items there that you can play with and those levers and shift them around. Again, also receivable days, payable days, inventory days. And that's consistent across all three of those items. So really important. Anything you can do there would help. So as you can see, cash flow is not just cash through the bank account. There's obviously more elements to think about.
Thank you, John, for the presentation. That was very useful, and it has a lot of good takeaways for people to think about. I guess, what you're saying is that it's best to have your cash forecasted and to have visibility, so then you are prepared. But I think a lot of businesses will hit that wall when they are actually in the red. So while now they realize that they need to have a cash flow plan and to have it forecasted, what can they do straight away, 1, 2, 3 in the meantime, to relieve the stress, and then sit down with a business consultant to actually look at managing their cash flow?
Yeah, Lena, that's a great question. I think you need to understand your cash position, where you are right now, in terms of what are my cash flow needs, what cash do I have and what's coming in, and am I short of cash or not? And if you are short, then you need to make a plan, right? Am I going to go to a lender? How am I going to acquire that money? Do I have to go to the shareholders to ask them to put money back in? So I think having visibility of what that looks like now, right now, am I fine for cash or am I not? I think a lot of business owners tend to just worry about, I know it's wages in a couple of days. I've just got to make sure I've got enough cash in. I'll ring my debtors, make sure they deposit money. But they don't really look at that forward-looking piece. So they really need to understand what that looks like now. That's point one. The other thing then looking forward is creating scenarios. So you can look at the current position, but then it's about, okay, what happens if my sales go down? What is the impact on the cash then? So being prepared and looking forward. But great question.
Okay, now another question is, when it comes to, I think a lot of business owners, because they get nervous about the cash flow, they almost want immediate reports that would tell them live how much do you have now, so that they can calculate, well, how long it will last me. So you mentioned that there's a lot of tools that can help with that. Can you give us an example?
Yeah, correct. I mean, we've got a tool depending on what accounting system you're on. So if you're on Xero or QuickBooks, that can certainly help. So what it does, it actually pulls through your actual live transactions from the accounting system. So at any time, it actually tells you what your position is. So that's really handy. I guess gone are the days of trying to do it on a spreadsheet with Excel. I think that's really dangerous, because if you make errors with formulas or you forget about stuff, it's really easy. It also makes it really difficult if you have to shift stuff around. So you have to delay payments, or you have to pull payments forward. It's dynamic enough with the software to be able to look at that. So I guess there's nothing wrong with using Excel. That's okay, but it's not the best way to do it. You need to use the software tools that are out there. Correct.
And one last question for me. When we talk about the balance between cash in and cash flow and the timing, what's the importance of the payment terms in your commercial contracts?
Yeah, that's really important. So you're talking about payment terms, I'm assuming, for suppliers? Yeah, 100%. So initially when you, I guess, sign up for an account with someone, they'll normally give you 30 days from end of month. But at some stages, you might need flexibility to go longer than that period. So a couple of important things. Number one, talk to your suppliers early. So if you know that you're going to struggle and you're going to pay them late, then talk to them, but give them an idea of when and tell them why. Like, that's pretty common. I can tell you that, I'll give an example. One of our clients, they were struggling to meet their terms and asked and said, can we have 45 days from end of month? Because we know we've looked at our cash flow, and, the problem is from when your goods leave your store to get to us, that takes 2 weeks. So until I've actually got it, I can't make the articles or the items, which then means I've got to make it, then I've got to get it out the door, and I've got terms with, obviously, my customers. So talking to them, seeing if you can adjust your terms, but really important, your credit agreement will state there, one, what the terms are, and remember also the other thing, there might be a removal clause in there. So in other words, until those goods are paid for, they don't belong to you. That's the other issue as well.
Thanks, John. And I wish I'd come to this presentation sooner. So have you got any advice for a business that's already in a little bit of trouble? I mean, I know that, we should have had more forward planning and, been better prepared with cash flow, but we've been really caught out. We're in a bit of a tricky situation now with suppliers and getting paid some of the invoices that we've issued to customers. Have you got any advice for what we can do to manage that or improve the situation and get some money in quicker to help with that cash flow situation?
Look, I think that's a great idea. It depends on from business to business. But for example, if let's say you're a retail store and you sell goods, you can do things like sales so that you can mark down prices so you can get cash in that way. That's one option of doing it like that. The other method, I guess the key thing is to look at your terms around payment. Do you need to change those? Do you need to amend those? Now, if you've got existing customers, that's harder to change, but then potentially new customers that are coming, you might say, no, you need to be COD first for the first while, or maybe you give them terms but not as generous as everybody else. So those are two things. It does depend heavily on the particular business and what that looks like, but yeah, that's an example.
Yeah, I think a big part of the problem is that we haven't really put in place really strong payment terms for ourselves, for the customers. So is there a way, have you got any help you can provide to sort of reach out and get those outstanding invoices paid so we get money in?
Yeah, that's a great idea. I mean, there's two avenues to that. So the first one is financing your invoices. So then you'll get a percentage of that released up front. So that'll alleviate cash flow pressure. But with that comes interest charges. So you need to make sure that you've got enough margin to cover that. It's probably point one. The other way to do it, if they're issue clients, you can go through debt collectors. You can obviously do that. Also, you could issue letters. I know through our legal team they could potentially help you there to try and get that money in sooner. The other way to do it, you could charge interest depending on what your agreement looks like with them on late payments. That's another way to sort of deal with it as well.
I suppose one quick question that would be on the minds of many small businesses is, if I do have cash flow problems now, to manage my own expectations, how long would it be to try and get myself back into the black?
Yeah, it's a great question. Depends on how big the hole is, I guess. One of the things behind cash flow is a symptom of something else too. So then you have to look deeper and you potentially have to look at the business model. And one of the things that a lot of smaller businesses, especially since COVID, have experienced is what we like to call margin compression. So in other words, the differential in the price between what you charge and what it costs you is obviously reduced. So in other words, let's say, you did for $100 worth of sales, your cost was $50 to produce. Now, these days, potentially that might have gone to $70. So you've lost that $20 margin, which has disappeared. So it's kind of linked. So to tell you around how long it will take you, I guess we normally look at the business model to see, okay, what does that look like? There's normally stuff that we need to adjust there. And look, timing-wise, it can be 6 months, it can be 12 months, it can be longer. It all depends. I guess it's not a quick fix.
As you navigate the complexities of running your small business, we want you to know that we are by your side. At Business Solutions Hub, we offer a dedicated team of HR, workplace relations, and business specialists. Whether you need tailored advice or strategic insights, we're here to assist you every step of the way. If you have any questions or need further assistance, call us on 1300 445 687.